Well, thank you, Nicholas. And I must say, it's a really great pleasure to be here. I always love coming to the RRS events, not only for the friends who operate it, who've become friends now, but it's also a great crowd to talk to. And normally, as Nicholas said, I do tend to talk more about the market and what we do. I've become aware that there are a number of shareholders through this audience, and each year it seems to grow. So this is an opportunity for me to be able to attach the way that we feel about the market with what we're doing about it as an investor. So I'm really pleased to be able to make that linkage today, and thank you to Nicholas for being able to accommodate us in the schedule there. Sorry, I keep forgetting what my animations do, so apologies for that. Very pleased about this slide. I'm getting far better at photography. Last year it was a nice scenery, but with a car with its door open. Now it's just stars. So as long as I'm the Managing Director of Lion, I'm going to be taking the photos for the disclaimer page to make them a bit more interesting. I'm very aware, I've been told that males in the audience, something about the tone of my voice, they don't pick it up nearly as much as the ladies do. So I'm trying something a little bit subliminal here. If you notice anything on the screen, it's completely normal. We're all here for the exact same reason. We're all here because we're interested and we're investors in the same space. And I think we all like it for the same reason. There is something about micro-cap miners and micro-cap developers and explorers that attracts us all. And that one thing, if I had to put words around it, is you can get a stunning return off of a very small outlay in this part of the market. This is where you can get the best return in a stock than you can get anywhere else across it. I mean, forget tech. You can blow it out of the water with a discovery that turns into a great mine that gets taken over, and you're there for that journey. It's amazing the capital return that you can get from that. And during the right part of the cycle, the return across the sector makes it the best returning sector as well. So we're all here to try and find ideas there. But that leads us to the major challenge in that space, which is that it's exceptionally crowded with companies and opportunities, and just finding the opportunities within that can be a hard part of it. It also produces behaviours within that sector which can be difficult to look through, and they might be unpleasurable from an investing point of view if you could see through what's being said to what the reality is in some companies. Not all by any means, but that is the filtering challenge for a lot of people. How do I get into those opportunities that are going to produce that best return? So that's why we're here. And that's the focus of Lion Selection Group. We're an investment vehicle. We're listed on ASX. We trade every single day. And we are focused on microcapitalisation resources. So the companies at this conference and the other RRS events, plus many more, are the focus for us. And I talk to a lot of investors about the challenges of looking into this space. I mean, I talk to a lot of retail people, high net worths and things, and there are constant things that come up. Even at this conference, the questions I get asked show that there is a great deal of technical information which most people are just finding it hard to penetrate. And with a technical background, that makes it easier, but you know, it's jargon and it's a bit of a barrier in some cases. It's a highly cyclical industry, so when you time your entry across a bunch of stocks can materially affect the outcome for you if you get that timing wrong. And there's a huge concentration of people which it's very difficult to get a grip on, and whether or not you feel they're good or bad or compliant with your ethics. But I think the biggest challenges which exist for a lot of investors in this space, judging by what they tell me, is that they know there's a hell of a lot of deal flow, and they often get quite pissed off that they're only seeing a small subset of it. You know, a lot of the deal flow in this sector goes to the first 10 phone calls that a broker might make when they're trying to raise money. And that's something which a lot of retail people miss out on, and sometimes even miss out on the ability to follow that money with an SPP or something. And the other challenge, which I can see, I don't think it's expressed, but it is remaining liquid enough to be able to follow your money and take advantage of the opportunities that you think are the good ones, but knowing you need to invest, you know, 1, 2, 3, 4, 5 times in order to see something through to its logical outcome, and having the money which is available at the right time. That's a big timing issue for a lot of people as well. All of those things have been turned to our advantage in Lion. So we're a vehicle which is extremely well cashed at the moment, and all of those challenges which I mentioned, you know, we get the deal flow, we monitor the cycle, we get a lot of phone calls. So it's a vehicle which tends to make ends meet, if you like, for investors that don't want to do that themselves, or feel that they'd like to see it as part of their investing approach to that part of the market. So just to unpack one of those factors a little bit, and cyclical timing is one of the most important things which you need to be across to be deploying investments into this space. If you invest in 2020 and you put all of your money away into this part of the market, your investing experience since then will have been extremely subpar. If you were investing in 2000 and loading up on stocks for the first 2 or 3 years of that decade, by 2007 you would have made an awful lot of money. So the two contrast very strongly. And this is absolutely central to our investing behaviour. We pay a lot of attention to what we think the mining cycle is doing. We express it as a clock. The clock goes round and round. You get the same symptoms or behaviours at the same sort of position on the clock each time. So that's how we express it. And this is something we talk about more frequently than we talk about individual opportunities. What time is it? What's the market doing? What is the cycle doing? And what are the behaviours? How do we adhere to this though? We took $95 million out of the market, which was about 90% of the valuation of our company in 2021 and 2022. We felt we were coming to the top of the market and we went to 90% cash. I can't think of any other investor which has done that. We felt it was close to the top. It was definitely a risk for us because if you miss the last little bit of it, you can look silly. But we managed to extract ourselves from some assets which would have declined rapidly in value after that had we not. And we went through a couple of large M&A transactions in order to do that. It's also guided our re-entry. So we've been investing since the top, but the most aggressive part of that deployment for us has been in the last 12 months when we've seen the opportunities really start to become quite tantalising for us. So just to paint a picture of that, I like to show how different asset classes have behaved. And the performance of the top 100, the ASX 100 Resources Index, so this is the 12 or 13 resources companies in the ASX 100, going back to an arbitrary market peak. I've said April 2022. This is when certain indices and commodities all peaked close to each other, so market top in my eyes. That index is off 16%, so that's the BHPs of this world. That's not a tremendous loss, and that could be within the normal volatility. It looks as if in the last 12 months that took a leg down, and it certainly followed some of the main commodities in terms of their direction. If you lay onto that the rest of the Australian market, those resources have fallen out of bed a bit. So there's almost a 30% performance difference between what the rest of the market, guided strongly by banks and some of the larger industrials on the market, and the miners. If you put on the small caps, the micro caps in the resources space, they absolutely fell out of bed. So in a time of circa 3 years now, they're down to a quarter of the value that they were at that market peak. Which means that if you had cash at the market peak or you were cashing out at the market peak, your purchasing power is multiplied by about 4 times. So I wanted to highlight not only the cyclical sort of effect that has on the downturn, but also the opportunity that provides, because I don't know if we're at the bottom. It certainly looks to have levelled off for those smalls, and I think that's probably just because people have run out of things to sell or they've forgotten that they still hold it perhaps. Right now, there are opportunities to be investing, and that is what we are doing. But when I turn my gaze to the future and think, well, okay, you've talked about how far down it's gone. Is it going to be any good going into the future? This is the chart that I think about, and it needs a bit of unpacking. This isn't one index, this is a ratio. So going back to 1970, it's a massive basket of commodity prices divided by a massive basket of equities. And what it shows, in my eyes anyway, is that there is a cyclical behaviour that swings from a focus on equities to a focus on commodities, to a focus on equities, to a focus on commodities. And right now, the global market, that big bucket of cash which is focused on something at once, is looking at equities, and it's been driven by tech. It's at a more extreme position than it got to in the dot-com boom, and it's sitting at a position where history is about to start to drag it back one way or another towards more of a commodity focus. Now, will that take an energy transition? Will it take money starting to leak out of the tech space? If the real use of tech is only putting my face onto a woman's body, that's probably not going to be so profitable that it justifies the multiples that you see on earnings in some of those AI businesses. And as AI starts to be taken up and should translate into earnings, we're going to know whether or not investors want to stay invested in those businesses. There have been tens of times going back through centuries where money has tumbled out of a tech story into a commodity story. So what I can say with confidence is that the biggest mining booms have happened off the back of a tech fascination. So I'm looking to that as being something in the next 5 years, which is going to be potentially quite exciting. And that's what we're getting our portfolio ready for. How will history judge that? Well, I think probably as underprepared at the moment. The global mining industry is underinvested in sources of future supply. So I think that's probably something which bodes well for general tightness coming into commodity markets when you look at just basic supply and demand. But we see things like the Indian economy coming along, possibility of an energy transition, the Chinese central bank leading other BRIC nations into gold as a purchaser, and the effect that that now starts to be having on the generalist investors across the world looking into gold. So there's a lot of things which to me seem poised for we are close to the bottom. Now, I don't know if we're at it, perhaps we're even slightly past it, but I think it's possible to say it's almost or nearly time for the stocks which have been most severely depressed through that down cycle. Okay, so that's the upside coming story. What does Lion do about it? How do we do it? And that's really what's on this slide. And it's kind of a left to right process. One of the things which it provides a major advantage for Lion is the amount of deal flow that we see. We see it in unlisted companies, we see it in listed companies, we see it with enough time to be able to perform due diligence. We see probably 1,000 stories a year. Now that's an average number. In some years it's a bit less, in some years it's much, much more. And I think 2025 is going to be a year where the phone does ring off the hook. So that 1,000-ish number is going to be higher than that in this year. And that means that we can look across those 1,000 or more stories and say, well, what are the better ones here? It's impossible if you're only seeing 10 opportunities within that to know on a statistical basis that you've seen the 10 best. It's statistically quite improbable. So to see far more of them puts us in a position to be able to say, okay, our sense is that these are the better ones and they're the ones that we want to do. Great advantage to start with, and it means that we've got to filter. We filter on two things primarily, first on people and then on valuation. So we're looking for upside and we're looking for people who can deliver on that upside. And of that circa 1,000, the people and the valuation filter probably knocks that down to about 100 companies, which are things that we think have the upside within them that is deliverable. But then the question is, do we want to be in those? And we're probably going to do 10 or 15 rather than 100, right? So the thing which really narrows that down is the risk assessment. There are a lot of things which have great upside associated with them, but the reason why we don't do them is because we can't hold 5% of that company, capture the upside and not get wiped out at the point where one of those intrinsic risks comes and manifests in the company. And I'm talking about things like a lithium price falling by 90% of its value. They're the kinds of things which we're very cautious about. So we invest in things that we can see our way in, we can see our way out, and we want to have at least 2 exits for the investments that we're tumbling into. Putting that pathway into a few more words, the market performance. Top in 2021 and 22, we were selling. We took money out of the market. We watched the market fall by 75% and we've been investing. We've put money away most aggressively in 2024. And the pattern for us looks like circa $31 million invested in the last, let's say, 2 years. 3/4 of that was last year. And that $31 million that's been put away has gone up 66% in the time that we've held it. So this investment strategy is paying right now for us. It is performing in a market which has been pretty shitty in that time. So I'm exceptionally pleased with that. But I've got to think about the future as well. And my expectation in the mining market is that we're going to see a mining boom. We know history will deliver that. So let's just wait and see. Risk factors will come out of the microcap sector generally that will uplift the explorers and the developers that we hold. And each of the stocks is going to be de-risking itself. We expect to be able to exit the companies that we've invested in for multiples of what we've paid. That is the investing outlook and expectation for us. That's our portfolio. I'm not going to unpack that. It's suffice to say, we have a share there in over 10 million ounces of gold resources. We've got our foot on 2 multi-opportunity exploration plays, which we've got into exceptionally cheaply. So that option value is really in place for us there. We've got a share of one of, it'll be the largest clay-hosted rare earth deposits in Australia. It's a monster. It was resourced just the other day. And a district play that could uncover a new district for metals in Australia as one of our exploration plays. So there's a lot in it in terms of value unlocking as well as the optionality of discovery. And the thing which I'd like you to take away from that is that this strategy is working great. Lion's an LIC, and LICs are all discounted in the market at the moment, particularly the small ones. But we know that that discount narrows and goes to a premium when your investment strategy plays out and the market picks up. So that's what we're waiting for. You can buy Lion at the moment for about 55 cents and have 75 cents of value. I want to leave you with 3 just quick thoughts. First one is the return from these stocks is fantastic. It's a great place to look to put your money for that sizzle. Now is a great time to be gathering it. but it's peak fear, and people are worried about staying liquid enough to take advantage of this. Line's investment strategy is working. It's working right now, and we still have the boom to come to deliver more. So I'd love to see interest from you guys. You don't have to buy the stock, but there's a QR code on the screen there. If you sign up to that, I'm going to be sending out this presentation in the next few days to subscriber list, and it's going to have a set of appendices which have a great deal more charts and things for you to look at. So if you'd like to take that down, I'd love to see you there, and I'll follow up with an email once I see who's joined that list in the next few days. So thank you very much for listening, folks. And Nicholas and Sharon, thanks very much for having me once again.